Yo, welcome back. Acquire and operate. For the love of the game, we are buying and operating and growing and having tons of fun. A portfolio of micro SaaS companies, and we're doing it in public. This is Kale back with you, and we are jumping in today to a musing, which is, I guess, the chaos going on in my mind at any given point in time. But today, jamming on 13 conventional and contrarian points of view in private equity buyout investing. And I'm going to mix it up just a little bit and just kind of jam on this one and read out loud what I wrote here. So Sir John Templeton famously said, if you want to have better performance than the crowd, you must do things differently from the crowd, which makes a lot of sense, right? And I guess in a conventional kind of business context, right, like according to business theory, over time, all profits get competed away, right? So if you everybody kind of rushes to do the same thing, I guess, over time. And so this sentiment is pretty straightforward, though the human condition is tricky. We tend to get caught up in hype cycles, for sure, and we're rarely conscious of it. I guess to make matters more interesting, we're also cooperative animals. So we're wired to fit in such that we have a greater chance of survival. There's a Japanese adage, the tallest nail gets hammered. So we have a tendency to kind of get excited about stuff. We have a tendency to want to fit in and kind of keep up with the Joneses, I think, to a degree. So with all that said, choosing the micro SaaS game immediately places us in the contrarian camp. So just based on deal size, right? And I think a contrarian point of view for its own sake, though, can lead to awful outcomes. I was listening to Invest Like the Best the other day, and it's like, it's a very bad thing when you're the only one wrong as an investor. But more often than not, you have to have a different point of view to have kind of crazy outcomes, right? So that's an interesting trade-off there. That's something that we all have to balance. So perhaps the most important thing we can do is establish an independent point of view. Obviously, think critically, try to seek out and discern unappreciated value, and then kind of earn our ability to act as a function of building conviction, drumming up insight to take action and kind of put it on the line. So a lot of stuff there, some kind of mental models, some, I guess, world views, some things that are at odds, some trade-offs, etc. And I think regardless, it's always useful to map the territory, right? Like, all right, so we agree that we need to have a differing point of view if we're going to have a chance at outperforming our peers, but we also don't want to be the only one, or just kind of take an alternative point of view for its own sake, because that can leave us, getting screwed. It can be that everybody is not taking this point of view for very well-founded reasons, right? So we don't want to just kind of buck that trend. So I thought it would be useful to map the territory, so to speak, and kind of lay out like, all right, well, what is convention in lower middle market private equity buyout investing? And at least in that sense, we're clear on like, oh, oof, okay, I totally have a different point of view when it comes to this. So we can build kind of awareness and in clarity as kind of a default of that. And then obviously we can be intentional about like, okay, like I don't subscribe to that. I think that convention is wrong. And we can kind of pick our spots, so to speak. So let's dive in. So the first and most obvious one is deal size. So conventional, target deal sizes are north of 3 million annual recurring revenue, regardless of the competitive landscape. So they're like, hey, we don't play sub 3 million ARR. It doesn't matter what the valuation multiples are. It doesn't matter how competitive from our peers, right? So other financial sponsors, other acquirers, so to speak. It doesn't matter how active it is. So it's kind of, we don't care if it's bloody water. We're going to play in this space, right? And the contrarian point of view here would be to seek smaller overlooked deals, sub 3 million ARR, and that's just kind of one measure, despite the lower kind of perceived return on effort. Then moving on to fund size dynamics, convention is, larger funds over time, which is usually a big proxy of success, right? It's like, hey, we rocked it. This fund was successful. Cool. Let's raise more money to do more of what made us successful. Obviously, that leads to larger investments, more management fees, et cetera. The contrarian point of view is to operate smaller, focused funds for nimble, specialized strategies that are often kind of fixed too, right? It's like, hey, we're going to keep the fund size at this size because we think that's optimal. It doesn't matter how successful we are, or it has kind of one fund size has a little impact on the subsequent fund size because it's kind of determined that those things we shouldn't scale the fund over time, right? That's not going to help us perform better, et cetera. Industry selection. Invest in established industries with proven stability. Contrarian view is to get after emerging or disrupted sectors, ones that are a little bit up and down. Profitability versus growth. Convention is, we want kind of solid profit margins or a clear line of sight to cash flow positive. Contrarian is to think probably more about growth. And this is, you could kind of disagree with this, but I guess there's a distinction between profitability versus growth. And I think convention is like, hey, we're trying to optimize for profitability here. Contrarian is perhaps more of a take on growth. Ownership and influence, obviously, convention is a majority stake for full control. Contrarian is, I guess, to consider minority stakes to leverage strategic partnerships without direct control. So this starts to feel more like growth equity or venture outright. But I think it's important to understand, okay, convention versus contrarian as it relates to ownership. Kind of obvious in buyouts, but or it's an exploration, okay? Okay. Value creation methodology. So I think convention is apply a universal approach to value creation. Contrarian is to customize value creation plans based on each company's specific situation. Customer-based development. Convention is to, I would say, prioritize organic and broadly expand the customer base for market share. So it's like, hey, if we're going to grow this thing, we need to acquire new accounts, new customers, new users. And the contrarian view is to deepen existing customer relationships to expand the lifetime value. Those two things can obviously play together very well. But I would say convention is more of an emphasis on organic growth. Financial versus operational focus. Convention is to rely on financial engineering for value creation. So we're going to saddle the business with debt. It's going to be a steep leverage buyout. We're going to cut costs. We're going to then exit or create some kind of multiple expansion, pay off the debt. And we didn't really change the business. We just eked out a return in some capacity, mostly as a function, again, of financial engineering. That's kind of convention. And those tactics are a little bit played out. Contrarian is to prioritize operational improvements and organic growth as the primary value drivers. As it relates to operational improvement, convention is to implement broad operational changes post-acquisition. Contrarian is to make incremental strategic improvements without core disruption to the business. Operational complexity, convention is to avoid companies with extensive operational issues, and the contrarian take is to pursue these companies and kind of look at them as providing solvable challenges where you can generate a lot of value creation, a lot of transformation for the business. Technology strategy, this one's interesting. Convention is to kind of follow the current technology, of like the industry standards that are in your peer group, that are in your category. Contrarian view is obviously to innovate with new or unconventional technology applications. So generative AI is obviously pulling all of us in a very funky direction right now. And then two more for you: strategic acquisitions versus niche markets. And this is a little bit more indexed towards kind of roll up or platform plays, but convention is to aim for strategic acquisitions that fit within current models, and contrarian view is to focus on niche markets or unique models that large players overlook. So this is where you start to think about, okay, like, let's acquire Instagram handles for distribution, some weird stuff like that. So last but not least, geographic strategy. Convention is to focus on familiar, stable geographic markets, of course, and contrarian is to explore in unconventional regions with hidden potential. So this is something that I'm thinking a lot about lately, but it is a large world out there, and there's some cool software all over. You hate to stay handicapped based on, or I should say, just kind of keep the aperture too tight, fixated on North American based firms or on firms that have North American based users, and those are a big distinction there. Obviously different risk profile for each, but anyway, I better be careful. I'll take us too far down that rabbit hole. So cool. That is a wrap for today. Go get them. Y'all, much love. Appreciate you following the journey, and we'll be back next week with a deal teardown. Cheers.